Good morning, everybody. Welcome to this kickoff webinar for 2026, presented by myself, Gasly from TreasuryONE, and with me, Director and co-founder of ETM Analytics, George Glynos. So, George, we start off this new year. We had a lot of interesting times already for the year. Like I just said to you off air, I started working on 5 Jan again. On the 4th of Jan, President Trump invaded Venezuela, and I thought, yes, we're going to see a little bit of weakness in the currency, and a lot of it's going to happen, but nothing happened, and the rand sat at 1640. And since then, we've got a lot of geopolitical stuff brewing, a lot of Venezuela, a lot about Greenland, a lot about what's going on on the US front, and all of those things. And then the interstate decisions in the US is coming up, and all of that's going to have an impact on South Africa with our terms of trade. So that's our intro. With no further ado, I'm going to hand over to you, George, just to let everybody know what's going on in the world and paint a little bit of a picture of what's going on.
Yeah, thanks. Thank you, Richard. Good to be with everybody. As you pointed out, it's been one hell of a start to the year. And 2026, if this is the way it's going to start, it's going to be one of the most interesting that we've had so far. So as an analyst, I'm quite looking forward to it. As a business person trying to navigate some of these events, it's maybe a little bit trickier. But we do what we can, and we focus on what we focus, and try as best we can to make intelligent decisions with the information that we have. So let me jump straight into this. And I think the heading of my presentation already gives you a sense of what we're going to be talking about today. Because if it's the power of politics or the politics of power, one way or another, politics is going to be very central to how things unfold and whether markets surge or whether they come back down again. The interesting thing for me is trying to get to the nub of what's going on. So it's one thing to just focus on the news headlines, and Lord knows there's a lot of those that are coming out at the moment, and Trump is obviously quite central to most of those. But the interesting thing for me is the why. What's going on in the background to drive some of this behavior. And that's what I've tried to focus this presentation on. So if I can paint a little bit of a backdrop as to why things might be unfolding in the way that they're unfolding, in the way that we've interpreted it, perhaps it gives you a little bit of a sense as to why Rand might be behaving the way that it's behaving, why stock markets are doing what they're doing, why bond yields are doing what they're doing. So let me jump into it. So the first thing to say, and I think this is an important piece of the puzzle, is to focus on why now. What is it about Trump's presidency now that has him so motivated to engage the world in a very robust way, both with tariffs, with his geopolitical stance on things? It's important to try and understand what's going on here. And if you've been paying attention to Trump over the past year, it's been on more than one occasion that he's mentioned BRICS. So BRICS is clearly bothering him. And it's bothering him not just because it includes the likes of China, India, Russia, Saudi, the UAE, Iran, many of the problem jurisdictions that Trump has been pushing back against. But if you have a look at its contribution to global GDP, you begin to realize that this expanded BRICS bloc, if you like, the BRICS plus as they call them, as a percent of GDP is looking to overtake G7 through the course of the next couple of years. Now, why is that important? Well, it's important because the bigger the contribution to global GDP, the more the say that the BRICS plus tends to have over global international policy. The more say they have, and the more they get to create something along the lines of a bipolar world in which there's more than one center of power, the less the US can dominate the geopolitical backdrop in the way that it's been doing. So what it's done through the course of the past year is to try and re-establish itself as a leading world power, and it has done so through various forms of intervention, whether it be the tariffs, whether it be sanctions, whether it be supporting Israel, whether it be trying to end the war in Ukraine, whether it be bombing Iran, and more recently instituting regime change in Venezuela. We see him now active in Greenland. These are all very strategic. They're important in a number of different ways, and for that to happen, the US has to reassert itself as a global player. So it is trying to do so. It wants that dollar hegemony to persist. It wants its ability to be able to influence policy across the board on a number of different fronts. At the same time, he's also trying to take care of some imbalances that have arisen in recent years. And for those people that have been paying attention to what's going on in China, you will have noticed that their trade account has just been surging from surplus to bigger surplus to bigger surplus to bigger surplus. Increasingly, China has been consuming the world's productivity and becoming the productivity powerhouse to which it then exports to the rest of the world. Now, at face value, that doesn't sound like a problem, but in reality, it is becoming a problem. So not only is a lot of the world's productivity being centralized into one country, but it's being done through various methods of manipulation. One of the most obvious would be manipulation of the currency. And when you have a look at the currency and you look at it in the way that we look at it, you begin to realize very quickly that perhaps the currency is a little bit too weak for what it or a little bit too weak and encouraging those exports. Now that gives them a competitive advantage, which is something that the Trump administration has wanted to push back against. A lot of these tariffs are as a result of what's been going on in China and the manipulation that's been taking place in China. But over and above that, it's about infringement of property rights and a whole host of other things. So China has had its own sort of protectionist stance that it's been pushing, and it's done so with the express purpose of trying to boost its own economy. Domestically, China's economy is really struggling at the moment. It's under significant pressure. So the one way to prop up growth is to make sure that you can continue to export and at scale. In a way that helps promote at least the export industries whilst they're still undergoing a big credit correction in the housing market. On the flip side, you've got America that's looking at all of this and watching their trade account shift from bigger deficit to bigger deficits, and the Trump administration said no, to hear no further. And in fact, if anything, we need to try and rebalance the situation. And so rebalance they've tried to force. Now, at what expense? Well, the expense comes at the expense of the rest of the world. And why do I say that? Well, because of the imposition of tariffs. So it's a protectionist stance that they've taken, but it's one not only to push back against China, but it's one to render the US economy and the dollar a little more sustainable over the long term. So we're not talking about over the next year or two or even three. We're talking about the next 10 to 20 to 30 years. And so what you see on the chart on the right has been a very strong reaction function to the tariffs that have been imposed by the US. And you can see that it's had an extremely positive impact. So you're talking about now a trade deficit which has shrunk to the narrowest levels in the US in some 10 years, which in itself is significant. But whilst that might be happening, what we do know is that the US's actions over the past a year or so has played a very significant role. In fact, it hasn't just been over the past year or so. It came after Trump's first stint in office initially sparked some movement. Then we had COVID and the way that the Fed responded to COVID and the way that the government responded to COVID with borrowing and huge debt piles building, et cetera, et cetera. But increasingly, the rest of the world started to feel a little bit uneasy about the way that the US was being managed. Enter President Trump into his second term in office, and that accelerated. So you can see quite clearly that the shift away from US assets started to gain momentum. And you can see that the official Treasury holdings as a percent of total reserves, and the blue line has steadily declined. By contrast, gold as a percent of total reserves, of international reserves, has risen and risen very, very sharply to the point where they're about to switch over. Now, we haven't seen that in some 30 odd years. So this is a significant development, and one that we are certainly taking seriously, because it speaks to these broad geopolitical shifts and consequences of the way that US has been conducting its policy and the way that the rest of the world has been managing all of this.
George, can I quickly interrupt you?
Yeah.
There's a question about gold. I've put on the ground. It says, have you seen the gold price? This should be the official title of this talk. But the question is, how hard can it run and how can it go in response to the geopolitical risk?
So obviously we've seen the gold price, and the gold price is part and parcel. It's a function of the buying that we're seeing at the moment. So in answer to that question, how much further can this go? I think it can go quite a lot further. And the reason I think it can go quite a lot further is because it's got fundamental support from the central banks that are actively rotating out of US assets and towards gold. And to give you a sense of just how correlated all of this is, I've had a look at the holdings of gold by central banks, and I've had a look at the holdings of globally versus the holdings of gold by the BRICS Plus and their proxies. And so what you find is that the rise in the gold reserves has been principally driven by BRICS. So again, it speaks to this big geopolitical play that's taking place between the US, which is trying to hold on to its control of global geopolitics, and BRICS, which is in itself trying to create the second axis of power to try and balance out the pressures that the US is exerting on the rest of the world. So in answer to that question, can it run further? Yes, I do think gold can run further. I think we're in a new paradigm right now where US assets are not favored in the way that they used to be favored in the past. And that as a result of that, what we're finding is that there's been a shift towards holding different assets that cannot be sanctioned. You know, how do you sanction holdings of gold? It doesn't belong to any one single jurisdiction. And you can't just sanction anyone that holds gold, because that would be sanctioning the whole global population. Everyone has gold jewelry. Everyone has some exposure to gold, either to a greater or lesser degree through their funds, through their investments and the like. So it's impossible to do, which is why BRICS has defaulted towards, or it's one of the reasons why they've defaulted towards using it. But there's also another underlying reason why BRICS have been purchasing this. And I was very fortunate about a year and a half ago to be able to sit in some strategic meetings that took place very high level in Dubai. And the comment that was made to me at the time was that Trump aside, what BRICS was gradually aiming for was to launch a stable coin, in other words, a digital coin, but this one would be backed by a combination of gold and oil. Now, that is massively strategic, because if you have a look at the makeup of BRICS Plus, you'll find that it's the world's biggest oil producers that are sitting there. And they naturally are going to have access to enormous reserves, which they can then control. But equally, if the major central banks that reside within BRICS are also the ones that are principally buying up gold, then you know that they're gradually building up those gold reserves for a strategic purpose. And we think that the strategic purpose could be this gradual push to establish a second global currency, not necessarily pegged to any one single jurisdiction, but one that globally would genuinely be a global currency, and it would be backed by real assets. So I hope that answers your question, but gold, of course, features very, very prominently. But it's not just about gold. As I've just mentioned to you with BRICS, it's also about oil. Now, Trump can't do much about the reserves that sit in the Middle East. He can't do much about Saudi pumping, the UAE pumping, Iran pumping, etc. Although to some degree he can control, and he has exerted some pressure on what's going on in Iran, and I'm going to get to that in a second. Same thing with Russia. But the Trump administration figured that if they were going to have strategic influence across the world, then they also needed to counter what's going on in BRICS with some efforts to control what's going on in the oil price as well. So there's not much that they can do about gold, but there is plenty that they can do with oil. And so enter Venezuela. Now, Venezuela, as you may or may not know, has got some of the richest oil reserves in the world. It's a different kind of oil. It's a very heavy, thick oil, which requires some refining. Interestingly, some of the biggest and most influential refineries that can refine such heavy crude sit in America. So America sits with the refining ability to handle Venezuelan crude oil, but there was another geopolitical reason why this Venezuela action took place. And that is because Venezuela was being used by the Russians to circumvent US sanctions, partly through blending Venezuelan oil with Russian oil, such that it wouldn't be identified as Russian oil when it landed wherever it was sold off. Much of that was heading to China, by the way. So in one foul swoop, the US government has thrown a serious spanner in the works of global oil trade and impacted very directly Russia, China, and Iran. And part of the reason why, how they've done that, is that, and that's the reason why they sent their maritime fleet down that direction, was to stop what they call the shadow fleet. The shadow fleet being a fleet that tries to, they switch off their radars, they switch off their transponders, whatever. They're difficult to track, but they're effectively been shipping, if you want, sanctioned oil to different jurisdictions. It's allowed the Russian military machine to keep going because Russia was able to secure revenues through the selling of their oil, which they ultimately blended in part with the oil from Venezuela. But so in one foul swoop, Russia has now suffered a significant hit to their revenues, which is going to impact the war on Ukraine and their ability. I think the idea there is for the US and Trump administration to force them back to the negotiating table. The second thing they've done is that they have now isolated the dark fleet. Interestingly, the dark fleet was also directly involved with shipping Iranian oil, which is also sanctioned. So all of a sudden, and I've got a couple of charts to show you guys, Venezuela was an obvious play for the Trump administration, partly because they would be receptive to a rejuvenation of their oil production. As you can see on the chart on the left, what happened when Maduro took over and started to run his effective cartel. That has now come to an end, and there's going to be a fair amount of investment, we expect, with some guarantees, of course, by mainly US companies to try and rejuvenate that. But it's also with the express purpose of trying to control future oil prices, as is reflected in the chart on the right. But here's the interesting chart. Since then, what we've had is a spike in the cost of very large container ships, what they call VLCCs, and the cost has risen because so much of the dark fleet has been taken out of commission. They're sitting floating out at sea, holding tons and tons and tons of oil, but can't be utilized for anything else. And they can't land anywhere and dispose of that oil because they're sanctioned. So all of a sudden, you've got Iran that's been impacted, Russia that's been impacted, and China that was buying the bulk of Venezuela's oil also impacted. So strategically, that was the play that the Trump administration was after, and it also wanted to tackle this particular issue, which is Iranian oil supply, which, as you can see from recent years, has been much higher than the Trump administration would like to see. So they don't want to see this oil being as strong as it is. But again, the one way to tackle Iranian oil landing up in China would be to stop the ships that carry that oil to China, and that's effectively what's happened with the military action that took place in Venezuela. So there's a whole bunch of knock-on implications of all of this, but it's all extremely strategic, and you can see this big play between the US and what's going on between China and BRICS. But it's obviously not just that, enter Greenland. So Greenland becomes another focal point, which no one really saw coming towards the third and fourth quarter of last year. There was talk of it, but everyone kind of didn't take it seriously. But increasingly, whilst the Trump administration is now exerting this increased geopolitical influence across the globe, they've decided that Greenland is now strategic as well. And so, why would Greenland be so strategic? Well, it's a route for Arctic missiles that can be thrown by the Russians across to the Americans. So they perceive that as a natural threat. Russian naval movements they can control a little bit better if they physically got a big presence there. They have been worried about Chinese encroachment, but that's very much more just a case of that wasn't just about Greenland. That was Venezuela as well. China was becoming increasingly important as a trading partner to Venezuela and indeed Latin America. So that action in Venezuela was partly related to that, but equally, China doesn't just stop at Latin America. They are trying to encroach in a number of different markets. And of course, that is not something that the US wants to tolerate. And the last obvious point is the rare earth minerals that exist within Greenland. So strategically speaking, again, another consideration, whether or not NATO allows this to go ahead is going to be an interesting debate. Trump has so much as said that there's no going back. I don't think it's as simple as that. Never before have we seen one NATO country impact another so directly and militarily speaking. So there's going to be pushback naturally. I think in the event that NATO pushes back hard enough and they don't allow the US to take a physical stake in Greenland in the way that the Trump administration would, what you'll probably find is that the middle ground solution might be that NATO establishes itself militarily to a far greater degree in Greenland than has been the case in the past. That's been one of the hallmarks of the Trump administration, by the way. They've gotten NATO to contribute a lot more to defense in Europe, for example, than they ever have. So there's been some consequence to all of this Trump bravado and bluster that's been coming for the better part of a year. And NATO has jacked itself up quite significantly. I'm waiting to see whether NATO then takes a leading role in Greenland and whether that will suffice to push the Trump administration away from Greenland. But he's pushing hard, and there's no question that he's going to force some sort of a response one way or another, whether you like the response or not. He's certainly pushing hard enough that there is going to be a reaction. So where does that all leave things? Well, we've got a dollar that remains heavily overvalued for the time being, but it has come off its recent best levels. in a number of years, in some nearly 45 odd years. So when one looks at this, the natural feeling is that, well, it's perhaps seen its best days. We think that for cyclical reasons that the dollar needs to come off. That's going to be compounded by fundamental reasons as well. The cyclical reasons are because we think that the US economy will ultimately slow. When it does, and the Federal Reserve becomes more active in trying to stimulate the US economy, that it will undermine the dollar through things like potential quantitative easing down the line. But more fundamentally, we are seeing this big rotation away from US assets, and we think that it is going to play a very significant role in unwinding some of this dollar valuation. At a speculative level, you can see that the speculative short positions on the dollar have grown. So they've been quite significant, and they are pushing harder, and they are weighing on the trade-weighted dollar. As you can see, there's a nice correlation between the two. And so the pressure on the dollar remains intact for now. Back to the issue of gold, you've also seen this big rotation for gold, but people don't realize just how far out of the realms of normal the gold price has performed, and very specifically through 2025, it has broken out of all of our statistical models in terms of standard deviations above and beyond what would have been an expected mean. So it really has dislocated very, very strongly. It's talking to that big geopolitical play that's happening, but there's fundamental backing to this move in the gold price, and it's coming from the major central banks. Again, just giving some perspective on what this potentially means for the dollar. The chart on the left, you see the custody holdings of US Treasuries coming off very, very sharply. So big central banks selling off out of US bonds. And we think that that is going to weigh quite heavily on the dollar, and that the dollar has a lot further to correct. You can see the central bank holdings of US Treasuries has been negative now for the better part of a year. Only now, very recently, as it ticked back up. But that's partly related to the way that the Federal Reserve has been behaving. We'll wait and see whether that's sustained. We somehow don't think that it will be. We're expecting those bars to dip back negative again. So as I finish off this presentation, painting a global backdrop, just to give you a really quick update on the domestic picture, things are looking a little bit better. Vechard was commenting offline just before this. He says it's amazing. We've seen stock markets wobble. We've seen a lot of geopolitical uncertainty. We've seen all of this, and Rand still keeps trading at these impressive levels. And my answer to him, my comment to him was, yeah, it's an interesting timeline, because we've had a combination of these very strong commodity prices that have arrived roughly at the same time as we've got somewhat of a rejuvenation in South Africa that's taking place. There's a reformist agenda that's afoot through Operation Vulindlela, and it has been having a marginally positive effect. On the short-term cyclical indicators that we have, we're in more buoyant territory, as we call it. Not particularly positive, but certainly not negative, and a relief from where we were. But even structurally, we've seen some improvement, and we're back to neutral territory on structural, something we haven't seen in a good couple of years. So that's at least a positive development that's taken place. The result has been South African bond yields coming down very, very strongly relative to US bond yields. And now we're sitting at some of the tightest spreads to US bonds that we've seen in nearly 20 years. So this is very significant. And I don't want to underplay this, but what you see there, this big move down in bond yields, reflects a big pushing out, winding out of a lot of the risk factors that plagued South African markets for the longest time. So the combination of improved fiscal performance, Operation Vulindlela, and the reforms that are coming through there, the removal of the grey list, the credit rating upgrade that we got, The combination of all of that has seen foreigners coming back into South African markets and re-looking at South Africa as a potential investment destination. Bond ownership, foreigners have been buying South African bonds. The year-on-year growth in bond ownership, you can see the blue line is inverted, by the way. So when that blue line tends to trend down, that means ownership is actually rising. And it correlates very, very well with dollar rand. So it's telling us that dollar rand is not trading unjustifiably at these levels. In fact, it's telling us that rand is trading more or less where it should be relative to these portfolio flows that we're seeing at the moment. But there are other factors that are afoot that we need to pay very careful attention to, and that's the big surge in platinum prices. Again, inverted, so just pay attention to that. That's inverted on the right hand side. So as the blue line goes down, it means PGM prices are going higher. And so what this is telling us is that either one of two things is going to happen. Either PGM prices are going to collapse back down again, or it's another in a long string of corroborating markets that are suggesting that the dollar needs to lose ground. Now, the reason why all of that is significant is because on the top left here, you're going to see a valuation chart of the dollar rand, and you will see that it's way past the midpoint, which is that purple line, and it's even below the extreme line on the bottom. Historically, we would look at this and we would say, this is a good time for importers. And in fact, we still think that this is a good time for importers. Rand has rallied really strong to where it was. But this is a cyclical adjustment that's taking place over 5 to 7 years. What it doesn't take into consideration is the possibility that we may have moved into a new band. Like, in other words, almost like a step shift in the trading range of dollar rand, partly to adjust for this reduction in the risk element attached to South Africa. Now, we can talk about that risk element and whether it's justified that the risk element is out of the market or not. I'm simply raising it as a possibility because the way I'm seeing foreigners looking at South Africa right now, there is a marked difference now compared to about 6 to 9 months ago. 6 to 9 months ago, we were staring at a dollar rand that was approaching $20 to the dollar. We're now sitting closer to $16 to the dollar. That is an enormous move. And the interesting bit that Richard commented on is that it's been sustained. It's not that it's just gone down and it's volatile. It's gone down and it's staying down. And it's staying down in the face of some fairly significant developments that are unfolding internationally. So I'm raising it as a possibility that this statistical model will slowly adjust through the course of time. But we need to consider the possibility that the rand might remain at these stronger levels for longer, not just because terms of trade have improved because gold and platinum prices are higher, but also because there's a risk element towards South Africa that has shifted. Against the euro, you can see that we're back to more or less neutral territory, not quite there yet on the pound. So still a good environment more or less for exporters on the pound, but again, very strong against the likes of the Aussie dollar. So this is something very specific to South Africa. The Aussie dollar is an interesting one because it's also a commodity currency, and yet rand has strengthened versus the Aussie too, which tells us this is more than just a commodity play. There is a risk element play to this as well. So I think the take home, Vichard, from all of what I've said to you is that everything that's going on internationally, big geopolitical shifts that are taking place, very interesting geopolitical developments that are taking place, are gradually pushing countries and investors away from dollar assets, away from US assets. That's kind of like a big strategic play, not just by investors, but mainly by your big central banks. The result is that it's hurting the dollar. The dollar has been coming under pressure, although from very, very elevated levels. So dollar could still correct 10% and only be back to neutral. We think that adjustment is currently underway, and so we need to take that into consideration when we look at dollar rand at these levels, and the possibility that it could remain strong, even perhaps break below $16 to the dollar through the course of the next few months if these trends continue. So it's a stronger rand theme, which means obviously that we have a lower inflation outlook. So targeting 3% now becomes quite a viable prospect. And so we look forward to the potential for another couple of interest rate cuts through the course of this year, although I don't think SARB is going to be in a hurry. And with that, Richard, happy to hand back to you and to take any questions.
Yeah, so you talked about interest rates. I'm going to jump in there. And obviously, the Federal Reserve is up next week with the interest rate decisions, and MPC as well. Do you think both of them will just do nothing in January and have the wait and see approach with all the lingering geopolitical stuff going on?
Yeah. So yeah, I would say that's the view right now that we're holding. In fact, if I have a look at the Fed funds futures, they're only pointing to the possible rate cuts come June, July of this year, regardless of the amount of pressure that the Trump administration is placing on the Federal Reserve. Maybe there's a tilt to bring it forward slightly, depending on who he appoints as governor. But at this point in time, I don't see the Fed moving anytime soon. And insofar as the Reserve Bank is concerned, they moved not so long ago. So for the time being, whilst we've still got inflation out today, probably going to hover around the 3.6, 3.7% mark, still above that 3% inflation target. The Reserve Bank does have to behave with a certain measure of conservatism. I do think that inflation will drop through the course of this year, and that we will get more rate cuts that materialize. But I suspect that our first rate cut only comes closer towards mid-year, and then again perhaps later on in the year. But for the time being, I think a mid-year rate cut is possibly on the cards. If rand goes below 16, maybe that comes forward to April, but again, not next week.
No. Okay. And then, secondly, is the bond markets worldwide. US 10-year Treasury yields is back at 4.20. We can talk about Japan. Their yields is at 30 and 40 years all-time high, 30-year highs on their 10-year yields. What is the bond market signaling to the world? What happens if something breaks there? Are we due for a correction? And what happens if the US stock markets corrects by 20%? How do we see stuff like that playing out for the year, more or less?
Yeah, I mean, it's a great question. So there's a bigger theme, and I mean, this is a theme for a presentation on its own. But that bigger theme is fiscal policy deterioration, not just in South Africa, but worldwide. In fact, in South Africa, things are looking a little better than they are in many other countries around the world. This business of bond yields being well elevated, whether you look at Japan and you look at their debt pile, which is enormous, or you look at the US and the uncertainty over their US policies, because they don't know if at the moment, you have a look at the excise duty collections, and they're hovering around 30 billion per month from Trump's tariffs, which is enormous. That would play a huge role in regulating their fiscal position, but they don't know whether those are going to be sustained and whether they're going to be rolled back. We're still waiting for the US courts to pronounce on that. So there's uncertainty with regards to the US fiscal position. The UK fiscal position, they're trying to stabilize that by hiking taxes and being quite draconian in the way that they're imposing those taxes. But the UK's got issues, and as do many countries around Europe, and of course, you have a look at what's going on in China and Japan. There's a tremendous amount of bond issuance, and it's not just by one country; it's by a number of countries, and COVID just exacerbated that and made it worse. The one thing that prevents those bond yields from flying significantly high is the possibility that you've got big central banks that can implement quantitative easing. And we've seen that from the Fed, we've seen it from the Bank of England, we've seen it from the ECB and the People's Bank of China. So the possibility is there for them to stabilize things. So I'm not overly concerned about a big blow up in bond markets, because I think the central banks are powerful enough to keep that contained. More interesting to me would be, what happens in a major stock market correction. Because there, I think there are some legitimate concerns. If you have a look at the valuation metrics, they look sky high. If it was just about valuation metrics, I would say, we're in trouble here. But it isn't just that. There's a very narrow field of investment that's taking place in America, but it's a very powerful field, and that's all this investment that's taking place in artificial intelligence and the infrastructure around it. Now, it may be a well-worn and much covered topic, but people don't realize that in 2025 alone, the investment into AI infrastructure in the US would have totaled just north of 300 billion. They're talking about that figure rising to 400 billion this year, and perhaps even more in the years that follow. So we're talking about enormous quantities of investment that are propping up some very important sectors that are generating productivity, efficiencies, and gains over time. All of that is still playing a role in keeping the likes of the US economy more buoyant than we had anticipated. And we've got to acknowledge that. So there's some really interesting dynamics there. But if we did have a major correction there, naturally, I think we'd have a reversal to, safe haven seeking and whatnot, and maybe that would be a catalyst for a little bounce on the dollar rand. But just remember, dollar rand at the moment is behaving quite separately from a lot of these markets. It's not paying attention to these international markets in the way that it used to. And that's largely because there's some good stuff happening back home, and there's a lot of support coming from the commodity cycle and the like. If only we could take more advantage of that through our mining sector than we are, I think South Africa could weather that storm better than most countries. But, Vikot, I don't know if that answers your question.
No, definitely does. There's the old adage that says, if the world's in turmoil and in trouble, South Africa performs well, and when the world's doing well, South Africa does bad. So it seems to hold true. So George, I'm going to wrap it up. In summary, it's stronger for longer on the local currency. Wait and see on interest rates, and wait and see what's happening in the geopolitical summer pot that's going on at this stage, if I'm correct.
Yeah, I think mainly it's nice to have some tailwinds for this country for a change. I just hope that those tailwinds are supported by genuine reforms. Vulindlela is underway and has been generating some good responses. The ports are being reformed. Transnet is going down the privatization route. So these are good developments. I just hope they translate into a little bit more. Clearly, we've got a lot of problems. VAT, wanting to close down because of illicit tobacco trade, and the smelters under pressure because electricity prices. I'm not saying that it's all hunky dory and there are no problems in South Africa. I'm just saying that off the base that we were at, we have normalized a little bit, and that normalization feels like, things are surging or much better in this country. It's just normalization. It's nothing to get overly excited about, but at least it does offer some relief.
George, I say thank you for your insights again this morning. To everybody out there, thanks for attending. If you've got any questions, you know where to reach us. You're more than welcome to reach out. Enjoy the rest of your Wednesday. Cheers for now.
Thanks, everyone.